Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business and finance with a bit of a smirk. Today we are diving into MACERICH latest quarterly report, a peek into their financial health as of June 2025. Let's get straight to the numbers because MACERICH's financial table is where the real story is. First off, as of August 8, 2025, they had 2,593.07 shares of common stock outstanding. That gives us a good baseline for understanding their scale. Now, looking at their balance sheet as of June 30, 2025, MACERICH's property holdings are valued at a hefty 7.1 on Zix, a lot of real estate. They also have over 121 million in cash and cash equivalents, which is good to see. But here's where things get interesting. Their mortgage notes payable are a massive $5.2 billion. That's a significant amount of debt that needs to be managed. When we look at their income statement for the 3 months ending June 30, 2025, MACERICH reported leasing revenue of $233 million, a solid figure. However, their total expenses, including depreciation and interest, came in at a much higher $80 million. This resulted in a net loss of over $41 million for just that quarter. Extending that to the first 6 months of 2025, the picture remains similar. Leasing revenue was $499 million, but total expenses jumped to over $567 million, leading to a net loss of over $92 million for the half year. This means the company is spending more than it's bringing in from its core operations right now. This difference between revenues and expenses means that the net loss attributable to the company widens significantly compared to the prior year. For the 6 months ended June 30, 2025, they had a net loss of over $91 million, a stark contrast to the $145 million profit they saw in the same period of 2024. That's a dramatic swing. Digging into the details, we see a big part of this swing comes from asset sales. In the first half of 2024, MACERICH had a massive gain of nearly $289 million from selling assets. This year, that figure flipped to a loss of almost $24.5 million. This shows how important asset sales were to last year's profits and how their absence this year impacts the bottom line. Another area of concern is their investments in joint ventures. For the first 6 months of 2025, MACERICH reported an equity in loss of unconsolidated joint ventures of over $1.2 million. For the same period last year, that loss was a staggering $130 million. While it's good that this loss has shrunk significantly, some of last year's huge loss was due to a write-down on an investment in Los Angeles Premium Outlets, which is a one-time event. Still, it highlights the volatility associated with these types of investments. The cash flow statement tells a more positive story about their operations in the first half of 2025. Cash provided by operating activities was $158 million in the prior year. This shows their core business operations are generating more cash. However, their investing activities show considerable spending. For the 6 months ended June 30, 2025, MACERICH spent over $2,066 million on acquiring property, which is a huge jump from approximately $41 million in the same period last year. This is largely driven by their acquisition of Crabtree Mall for $290 million in the same period last year. This is largely driven by their acquisition of Crabtree Mall for $290 million. They're clearly investing heavily in expanding their physical footprint. On the financing side, they brought in over $440 million from new debt while paying down about $134 million. This activity plus other financing means they ended up with positive cash flow from financing activities of $23 million outflow last year. They're definitely leveraging debt to fuel their growth and manage their existing obligations. Looking at their debt maturity schedule as of June 30, 2025, MACERICH has over $5 billion in consolidated mortgage notes, several years. Notably, about $76.9 million of this fixed rate debt matures within the next year. They expect to refinance most of this debt, which is standard industry practice, but it always carries some risk in changing market conditions. Their total long-term debt, including their share of joint venture debt, is a massive $6.88 billion. This level of debt is a significant factor that investors will always watch closely, especially given the interest rate environment. MACERICH is also focused on its path forward plan, aiming to reduce its net debt to adjusted EBITDA leverage ratio. They plan to do this through asset sales, strategic acquisitions, and improving their core operations. The plan identifies key properties to keep and others to potentially sell, which shows a deliberate strategy to refine their portfolio. On the shareholder front, they declared a cash dividend of 17 cents per share for the quarter. While these payouts are nice, they come at a time when the company is producing a net loss, which always raises questions about sustainability, unless those losses are temporary and driven by investments. Looking ahead to subsequent events on July 30, 2025, they completed the sale of Atlas Park for $72 million. This sale, coupled with debt repayment, shows they are actively managing their portfolio and using proceeds for corporate purposes. Now let's talk about my take on MACERICH. Financially, they're in a bit of a tough spot right now with consistent net losses driven in part by significant investments and the absence of large asset sale gains compared to last year. Their massive debt load is a definite concern, and while they are actively managing it through refinancing and asset sales, the sheer scale of it demands constant attention. The current strategy to refine the portfolio and focus on key assets is a sensible move, however, executing on it effectively. While navigating economic headwinds like inflation and interest rates will be crucial, they seem to be balancing growth through acquisitions with deleveraging efforts, which is a delicate act. The significant increase in capital expenditures, especially the acquisition of Crabtree Mall, show a commitment to growth but also strain their cash flow in the short term. Ultimately, MACERICH is in a transitional phase, needing to balance aggressive investment with financial discipline. Their success will hinge on their ability to generate stronger operating results from their existing and newly acquired properties and to manage their substantial debt effectively. The market's reaction to their strategy and ongoing financial performance will be key to watch. What do you think about MACERICH's financial maneuvers and their strategy moving forward? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for more insights and discussions. Thanks for watching, and we'll see you in the next one.